Well, as 2010 comes to a close, still a lot of questions about where we'll be next year. The U.S. economy slowly trying to pick itself up. A lot of questions about the debt crisis in Europe. Also, China's explosive growth. What does that mean for the global investment landscape? Here to help us break that all down, Liz Ann Sonders, the Chief Investment Strategist for Charles Schwab, and also Sam Stovall, the Chief Investment Strategist for Standard & Poor's Equity Research. Thank you both for being here. I appreciate it. What a year. But, hey, better than where we were 2 years ago, certainly. I'll start with you, Liz. Where do you think we are in this cycle of recovery? I know you say people are maybe more pessimistic than they should be.
I think that's not a big surprise given the depth of the downturn, but I think the sort of longevity of the pessimism is getting a little bit surprising now. We've had a view for a couple of years now that the recovery, at least at the initial phase, would be very square root shaped. So you'd get that natural V recovery with inventory building and some pent-up demand, and then you'd flatten out a little bit. A lot of concern about a double-dip recession in the summer. I think there's very little risk of a double-dip, save for some exogenous shock that can't be anticipated right now.
Swan.
I actually think we're re-accelerating. I don't think we're going to go into any kind of significant boom, but I think we're re-accelerating off this soft patch that we were in.
What about you, Sam? Do you agree with that?
Yeah, I think so. That basically you could call it a half-speed recovery. Since World War II, typically the first year of an economic expansion, we're up 6%. But we were only up 3% this time, and our feeling is it will continue at that half-speed rate, mainly because unemployment is likely to stay above 9% through the middle of 2012.
Well, what do you think the biggest questions are? I mean, Liz, you've written about housing remains a big question, jobs, and especially re-education when it comes to the new job market. Those are lingering questions that are going to have a big impact on this recovery.
Yeah, I don't want to put too little emphasis on housing, but mathematically it's simply become less important to the economy than it was several years ago. And what I mean by that is that the contraction has been so severe that it just doesn't represent the weight in GDP that it was a few years ago. So that doesn't mean, I think, if housing goes into a double dip, it's not going to cause some problems with economic growth. I just don't think it's as big a factor. The job situation is obviously a very key factor, but I think we're already seeing manifest itself in better consumer spending is that the 90% or so of the population that is working feels more secure in their job and are now actually facing increased hours and increased income. So I agree with Sam. I think it's going to take a while to bring down the jobless rate, but I think the underlying fundamentals are starting to improve.
What about, Sam, looking at 2010, what were the big surprises for you, and what do you think went underreported that really has been critical this year?
Well, I think one of the big surprises was that after we did decline by more than 15%, that we actually turned around before morphing into a new bear market. History would say no, that once you get that kind of an acceleration to the downside, then you do sort of slip into a new bear. So I was heartened to see that we did pull out before, in a sense, crashing to the ground. I think that one of the issues that keeps surfacing and will probably continue to surface is the debt levels globally, whether it's on the sovereign, state, local, or personal level. And so I think those are issues that until they really sort of dissipate, a lot of investors will be remaining on the sidelines.
And absent any black swan event, if you will, as you were mentioning earlier, Liz, like a terror attack or an unforeseen disaster, what do you think 2011 is going to feel like to us from an economic perspective?
I think it's going to be a bit better than what is presently anticipated, and I mean very presently, because their estimates have gone up almost across the board for GDP growth in 2011 for two reasons. One, the decisions that ostensibly are being made on taxes. But it's not only the tax piece of it, but it's the expensing as well as the payroll tax deduction. So that's quite a bit of stimulus in 2011 that I don't think was built into the numbers even a couple of months ago. And then, of course, we got the revision to third quarter GDP, which was better than expected, and that fed into some increasing estimates for 2011. And the news generally has been better than expected. So I do think we're looking something in the north of 3% range for GDP growth versus the mid-2s, which was the consensus expectation even a couple of months ago.
And if we do see that, Sam, what does the jobs picture look like? Because what we certainly know is that companies have learned to be extremely efficient and to need less bodies.
That's right, and certainly being able to leverage technology. Companies have been able to cut costs, they've been able to leverage technology, they've been able to increase their share buyback programs to therefore make earnings very strong, while the revenue growth has been only about a third of that. So companies have been very opportunistic, and as Lizanne was mentioning, that if we are wrong, it probably is that we are underestimating how quickly the economy does recover in 2011. I think most people are like consumers in the sense that they're going through recession fatigue. They're tired of denying themselves the ability to buy the things that...
We saw that in the holiday shopping season.
Exactly, and I think investors are like that too, and soon with all of this anecdotal money on the sidelines, it's going to be looking for a new home.